In today's video, we'll be looking at FVG, Smart Money Fair Value Gap, how to spot it, how to draw it correctly, and how to trade it alongside with imbalance price action. Because I don't trade FVG blindly, I look at it in terms of what imbalance price action. So now let me explain what those two terms. To explain FVG, we have to look at a 3 candle drop or a 3 candle push up, okay, rally. Now the FVG is simply the difference in the price from the week. You can see this week here and this other week. Once you see a gap there, that gap is called the fair value gap, FVG. And most people like trading when price trades back into this fair value gap, they will decide to enter the market. Now, I'm not saying that doesn't work, but I prefer, especially on the higher time frame, for price to fill up this 100% FVG. Most people, they decide to, maybe if price is trading back up, in here, when price trades into the FVG, especially the 50%, they decide to take a trade, okay, and they place their stop loss above here, above the FVG. This is a very risky way of trading FVG. Very risky. If you are trading it this way, you have to pay attention and watch this video till the end. Make sure you don't go anywhere, because I'm going to show you how I trade FVG and how I put it in confluence with every other thing. So for example, let's look at the example on the chart here. For example, like in this case here, we have an FVG here. You can see an FVG, this candle and this next one here. This is an FVG. Okay, I'm going to draw a zone there. This is an FVG here. Okay, why isn't that FVG? It's because this last candle, this first candle, this is the third, this is second, the third candle and the first candle, the wick do not touch each other. So that space there is simply an FVG. As price trades back in, most people will take their trade here to go short. Okay, same thing, we have an FVG here. This is an FVG. Okay, price came back in, you can see, beautiful move. But I don't trade it this way. Instead, there are other ways I look at it, and I'm going to share it with you here. This is an FVG here. This is an FVG. Price trade back in, move down. Okay, so that is how to spot an FVG. Yeah, we have an FVG here, but in this case, you can see in this case, price trade back up. If your stop loss was above the fair value gap, okay, smart money will take you out, because even the smart money are being manipulated out of trades. Okay, so now, since you know how to spot an FVG both in an upward and downward movement, let's look at bullish FVG. Now for the bullish FVG, okay, you see the same thing. You're going to look for the third and the first. Take note, the third and the first candle. Look at their wicks. Do they touch? If they don't touch, if they do not touch, then that is an FVG there. If it crosses, that is what they call price efficiency. Okay, price efficiency. So you expect price. The reason why this happened was that the buying order came in so much that people were not filled. There are some orders left here. So smart money may decide to come back, okay, to fill up this imbalance, okay, before moving. And that is the idea I trade. I trade the 100% filled. Okay, I only use fair value gap, this as an entry in the lower time frame. The moment this liquidity is taking the lower time frame, trade into the fair value gap, I can quickly enter there as an entry signal in line with other things. I'm going to show you that. So now, how do I trade this? Number one, how do I trade this? Number one, I look at it in line with what liquidity. I look at it as liquidity, because the fair value gap is a liquidity. Okay, that means orders. The liquidity are simply pending orders. There are pending orders in here. Okay, so the moment you understand that this is a pending order, you be able to frame a kind of trading bias in here in order to take your trade. And secondly, I trade the imbalance price action. What does this mean? The imbalance price action simply means the 100% fill of the fair value gap on the higher time frame. Here, for example, this bullish IPA, from the third candle here, this is my point of interest. Okay, when price trade back in here to fill the 100%, that is why I start looking for ways to buy. And the reason is because it must have taken out liquidity. Most people that try to buy in here, those that try to buy in here have been induced, okay, by smart money. Even the smart money traders have been induced to come long here. Okay, but what happens, price may decide to go lower, since most of them will be putting their stop just below the FVG. I wait for price to take 100% fill, and in that process might knock out some stops before I start looking for ways to enter this market. If this is on a higher time frame, like the 1 hour, 4 hours upward, okay, I wait for 100% fill. That's what I do. I don't trade it 50% FVG. I don't do that. I wait for the 100% to be filled, unless there are other reasons, confluence, that might make me enter the market. Okay, so now let's quickly look at a hypothetical situation here. Let's go to the 4 hour, like the recent trade I took here. I'm going to share the recent trade I took. Okay, now I shared this trade idea in my last video, but it wasn't in line with this concept. Now when I saw this, okay, this is the fair value gap here. You can see we have this wick low and this candle high. They are weak. This is your fair value gap. Okay, now if you are to trade the 50%, you can see what happened here. If you are to trade the 50% of the FVG and the stop loss just above this, okay, stop loss above this, so we put the stop loss close. This is the, now you have a stop loss above that. Let me use that. Okay, if we trade the 50%, price tapping the 50% and you are in, the price went down. Okay, it went down for some time. It all depends on how you manage your trade, but looking at it from hand side now, you see that the price went even further, okay, closing this fair value gap 100%, and doing that, it has manipulated some smart money guys out of it. Those that trade smart money, this move here manipulated them out. Okay, because if you look at the 1 hour, I shared this. I was actually looking at this trade here, this trade setup here. The reason why I didn't spend much time in here was because it was outside of my time. This was, price was approaching this in the Asian session. Okay, so I was hoping for price, probably we can see a rejection here. So I was expecting price to trade back in here, probably not too soon in the Asian session. Okay, maybe probably it build liquidity, then London session it comes in and then sell off. That is the only reason, because this was like a confirmation of the fair value gap. Okay, this was like the confirmation that price may continue going lower. But as you can see, by the time the London session came, okay, price pushed higher, then manipulating these stops here. Smart money traders putting stops above here will be taken out. Okay, they will be taken out because price decided to go fill up the daily imbalance, okay, and that is what I call the IPA. This is my point of interest. This is my point of interest, the 100% close of what? The fair value gap, and that is called IPA, the imbalance price action. So you can see when price comes in here, I move to my 5 minutes to get my confirmation to take this trade lower, and you can see so far the price may even continue going lower till we pick out this liquidity, okay, because this low here was supposed to print a new high, taking out this high, but since it's failing because I have my swing point here, we can decide to target this low. Okay, so that is how I trade my fair value gap. Now let's look at the lower time frame. Now in the lower time frame, I have an exemption to my rule. Okay, I have my exemption to my rule. So let's look for a chop here. Now you can see this was the last low that caused the manipulation. I want to share with you the way I look at the fair value gap. Now we have fair value gap here from this to this. Okay, now because I'm looking for entry, the moment price taps into this fair value gap, I can decide to now buy and to sell this market, but knowing where my stop loss will be. In this case, I'll be more conservative. I'll place my stop loss above this high, okay, not above the fair value gap, how people trade, or I've traded above my, for more risky entry, above the IPA candle. This is the IPA candle here. This is the candle. You can place your stop loss here, and you can see when price trade back in, blew through the fair value gap. If you have placed your stop loss just above the fair value gap, you'll be taken out of the trade before price moved lower. So you need to understand what is behind the fair value gap. The fair value gap are simply orders that were not taken, okay, and price needs to fill it 100% probably before heading lower. So this is what I want to share with you, because when you're trading fair value gap, you are also trading it indirectly without you knowing, with the IPA concept, with IPA. I did a video on IPA candle, okay, some time back when I started this channel. I'll link it up in this card here, or check the description below. Let me know your thoughts through the comment. What do you think, and how do you prefer to trade the fair value gap? I'll be glad to respond to each and every comment. I'll see you in this video for more on liquidity.